Today, the NASDAQ is down by essentially 3%, and it's led by Nvidia's decline of 17.3%. Now, I want to preface this video by saying I actually believe that this market sell-off is legit. Back at the end of 2022, we were one of the only commentators in the stock market that said the bottom was near. And I'll put up the videos on the screen. I mean, you can go back on my channel and see this. And back then, those videos were they still are. They're my most disliked videos of all time because everybody disagreed with my thesis that the market was bottoming and that 2023 was going to be a great year for stock market returns and 2024 would be a great year for stock market returns. Now, this has kind of flipped on its head. While I believe that this catalyst causing the markets to crash today is going to be a shorter term catalyst, I do believe that this stock market sell-off could last for a few months here. Suffice this all to say, I give you my honest opinion. I'm an independent analyst or researcher in the markets. I give you my honest opinion, even if it's not the popular opinion, and that actually can tend to be a great contrarian indicator. Usually when you have a bearish catalyst, and everybody in the markets agree with that bearish catalyst, you should probably fade that stock market correction, or you should probably believe that the stock market's going to continue to march higher and higher and higher. But this time is a little bit different because with this catalyst, most people are going to just dismiss it as a natural byproduct of the euphoria surrounding AI in the markets today. And again, that's a great contrarian indicator, this time probably indicating that this is a legitimate sell-off and that we need some time to cool off and kind of reset here in the stock market. So if you appreciate what I do on this YouTube channel, not always giving you the popular opinion just to get clicks, but giving my honest opinion, I would greatly appreciate you hitting that like button down below and subscribing if you're new here or returning and not yet subscribed. But anyways, let's get into this. What is going on in the stock market? Well, the Wall Street Journal put out a good piece on this. Silicon Valley is raving about a made-in-China AI model. And you've probably been living under a rock if you haven't heard of DeepSeek at this point in time. Over the weekend, all of the talk was about DeepSeek because it threatens the Magnificent Seven's dominance on AI. DeepSeek is called amazing and impressive despite working with less advanced chips. So right now, DeepSeek is kind of viewed as this David to the Goliath of the Western AI giants. So obviously your Nvidia's. That's a great example of a Western AI giant because DeepSeek claims that they're cheaper, better, and not bound by the same hardware constraints that the Western AI giants are. And that's problematic for several different reasons that I'll discuss. But first of all, it's because that big tech's moat around AI was that they have endless sources of funding. That was how they were kind of gatekeeping everybody else out of developing AI processes, is they had endless funding and most other participants don't have endless funding. But now all of a sudden, if you can do this for cheaper and better and more efficiently, it threatens that moat that big tech has. To give you some hard data on this, in the Wall Street Journal article, it talks about how DeepSeek said training one of its latest models cost them about $5.5 million compared to the $100 to $1 billion range cited by AI developer Anthropic just last year. Just last year. Obviously, this has created some skepticism of the legitimacy of DeepSeek. Are they lying about how much GPU power they really are using or how much GPU power they use to develop this model? That is a potential possibility. That could be a legitimate argument and skepticism for this, but that doesn't change the problem that DeepSeek just presented for the stock market. And I think a lot of people are just going to gloss this over, but it is so important. This week kicks off big tech earnings season, where on Wednesday you have Tesla, Microsoft, and Meta reporting earnings, and then on Thursday after the close you have Apple reporting earnings, and then a week later you have Amazon report their earnings. But the bigger problem is that Nvidia doesn't report their earnings until I think it's February 26th. Yes, February 26th, after the close, is when Nvidia reports their earnings. The problem is whether or not DeepSeek is legitimate, it reminded investors of the immense CapEx, the immense capital spending that big tech is spending on AI development. And that all of that spending has taken place with very little to really show for it. By the day, it gets harder and harder to envision a profitable venture in this AI space. This is problematic because it's actually usually during earnings reports where talk about AI spend is the most bullish of what AI can do for productivity enhancement, which I truly believe will happen over time. But the market is past due for some sort of check on this AI euphoria. This time around, as a result of what DeepSeek allegedly has, the tone around AI spend is going to be one of skepticism rather than bullishness and hype. Investors are going to start to question the amount of capital expenditures that management teams are putting into this. And if CapEx is soaring faster than revenues, that kind of exacerbates the problem because that puts negative pressure, that squeezes profit margins. And you can see this chart on the screen here. The red line shows you the Magnificent Seven's forward profit margin. So this is what analysts expect their profit margins to do over the coming 12 months. This has been on the uptrend since the end of 2022 when we went bullish on the stock market. It has been upticking, mostly because of this AI development and the hype around AI. And maybe some of this is legit, but we're past due for some analyst revisions to the downside for forward profit margins, especially if CapEx continues to outpace revenue growth, which again puts negative pressure on profit margins. And although I don't think it's likely, we also have to think about the possibility that skepticism surrounding CapEx on AI will actually slow spend on AI, which will actually slow the growth of the United States economy. Right now, GDP, we haven't gotten the numbers yet. We get them on Friday. In Q4, GDP is forecasted to have grown at 3.0%, which is solid growth, but it's just the historical average. 3.0% quarterly growth year over year in GDP is the historical average. If we start to slow down and grow at levels, grow at a rate less than that 3.0%, all of a sudden you have concerns surrounding economic growth pop into the picture while inflation is still stuck above 2.0%. And that could reignite, legitimate or not, stagflationary fears from investors and economists, which would be a negative development for the stock market. If DeepSeek is legit, this sounds backwards, but I actually think it's better for the United States economy and companies in the United States of America, despite the stock market selling off short term. And I'll discuss that more in a little bit. The immediate problem, though, is that the Magnificent Seven, so big tech, controls 30.5% of the S&P 500's total market cap. 30.5%. So if there is any sort of skepticism about earnings reports from the Mag 7 over the coming month or so, it's going to result in the stock market falling. And I actually believe that these companies are going to come in with tremendous numbers, but the AI spending question is going to muddy the waters and muddy the picture for these companies moving forward, which could result in the stock prices moving lower. But this is actually one of the positive developments that we might get as a result of this. I think this is going to force some sort of market breadth acceleration where, yes, our market rally has been highly concentrated in these big tech names that are highly focused on AI. However, now outside of the Magnificent Seven, so you can call it the S&P 493, so S&P 500 minus still 7 companies, in the S&P 493, you now have companies that will be cutting their cost forecasts for obtaining access to AI while also boosting their productivity forecasts as a result of this cheaper and more accessible artificial intelligence that they can incorporate into their businesses. That's part of the reason, if you look at the markets today, that small caps aren't selling off nearly as much as the NASDAQ is. Typically, if the NASDAQ has a really bad day, the small caps have an even worse day. But that's not the case today, because this development, again, actually benefits most companies, but it definitely hurts Nvidia over the short term if this means that demand for their GPUs is going to slow down tremendously. Now, a little bit earlier, I said something like it's getting harder and harder to envision a profitable venture in this AI space. And this is a great research piece from Sequoia, and it's titled AI's $600 billion question. The AI bubble is reaching a tipping point. Navigating what comes next will be essential. Sequoia actually has very similar thought processes to mine. They believe that the future of AI is very bright. They believe that it's going to lead to tons of productivity enhancements for our economy, which can only be a good thing for businesses and consumers. But the question remains, and it specifically is around the topic of capital expenditures on AI. To put it into more simple words, this comes directly from the research piece. They noticed a big gap between revenue expectations implied by the AI infrastructure build-out and actual revenue growth in the AI ecosystem. This problem in their first research piece was about a $125 billion problem, or a $200 billion question, I guess, is technically what it says here. But it has now become a $600 billion question. I'll leave a link to this article in the description down below. I encourage you all to read through it. It'll take you like 3 minutes probably, but I think it's so important if you want to understand what's going on in the AI landscape right now. Essentially, just to summarize all of it, Sequoia finds that US-based AI companies alone will need to generate $600 billion a year in revenue just to pay for their AI hardware. $600 billion just to pay for their AI hardware. They also go into mentioning how OpenAI still has the lion's share of AI revenue, but now OpenAI is being threatened by DeepSeek. OpenAI's revenue was $3.4 billion, which was up from $1.6 billion in late 2023. And while some startups have scaled their revenues into the less than $100 million range, the gap between OpenAI and everyone else continues to loom large. And it says, outside of ChatGPT, how many AI products are consumers really using today? And that question should really strike you and make you think. The answer is not many. And now that ChatGPT has been threatened, the question looms even larger. AI companies will need to deliver significant value for consumers to continue opening their wallets. And I don't think people realize that funding for this stuff is limited. Investors will only pay for the build out of this stuff to a certain point. Unless, of course, euphoria lasts forever, then yeah, funding is endless. But does euphoria ever last forever? The answer to that question is no. It never lasts forever. At a certain point, the markets and investors are going to want a show cause. They're going to want evidence that this spend is worth it and that it is increasing the revenues and profitability of companies in the United States of America, and that this spend is worth it. But right now, that has come into question, and especially as DeepSeek has taken over the news wire. And that's why I think, because those headlines are muddying the waters for big tech this earnings season, and because big tech controls 30.5% of the S&P 500's market cap, we're setting up for a time period in the stock market of less than desirable returns, in my personal opinion. Usually when management teams cut their cost forecasts, the stock market rewards their company, they reward their stock, but this time around, I'm not so sure that would happen. Even if one of these big tech companies comes out and cuts their cost forecasts for AI, I think it would be a negative development, because that would give credence and some sort of respect to the fact that maybe we are spending too much on AI, and maybe AI isn't all what it's made out to be at this point in time. So I put out a tweet yesterday, and I'm just going to read it to you because I don't think I can put it any better. Here's the bottom line of this situation. I'm short-term bearish for the first time in years. That's for the stock market. However, this dip should be bought no matter how long it lasts. AI is a legitimate productivity enhancer, but a check on optimism is past due. The economy remains in good shape, and the Fed does have room to cut interest rates if economic growth does slow. The next 4 years under Trump 2.0 should be extremely business friendly, and for these reasons, I don't believe the market dip will last long. So, to give you a little more information there, I think the market could dip into at least March, but I don't think this is going to be a dip that lasts all year long, like 2022. I believe that AI is legitimate. It's going to lead to tremendous productivity enhancements. I've said that several times in today's video, but AI as it stands today just isn't that impressive. The profits and revenues aren't going to come from large language models. It's going to come from real world AI. And I'm actually copying kind of a tweet that Farzad put out the other day, and I'll put it up on the screen in post-production. But he said, LLMs are incredible for entrepreneurship, but real world AI is where all the profits will be. I've been saying that for so long. And that's why I've been buying a particular company, and we just started a members portfolio. But it's a company that I think is going to be a life-changing investment for me. I think it's a company that I will retire on. It's a company that is in real-world AI and is being punished today, even though this development with DeepSeek really largely doesn't affect this company. This morning, we also bought some hedges against the Magnificent Seven because, again, I think this is probably bad for those 7 companies, but actually good for the rest of the 493 in the S&P 500. But if you want access to my buy and sell alerts, more in-depth research and analysis like this video, if you want just access to a cool community, and if you want to support me, I'm entirely self-funded and independent, so your support means a lot to me, but just the fact you're watching this video means a lot. But if you want to go the extra step, consider joining that membership. I don't encourage you to join it if you only have extra money to buy stocks. Use that extra money to buy stocks. Don't use that extra money to join my membership. But if you do have a little extra, if you want a little extra guidance on what I am doing with my extra money, that's when I would encourage you to join this membership. But absolutely not a requirement. I usually don't even mention it in videos, but I thought that this video was a good time to mention it. Anyways, let me know your thoughts down in the comment section below. I am always open to different viewpoints, and I am assuming that a lot of people are going to disagree with me, again, just because of the natural hype around AI right now. This viewpoint is not going to be a popular one that I shared in today's video. But anyways, if you are new here or returning and not yet subscribed, please subscribe down below. It means the world to me to see all the new faces popping into the channel. With that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.